And we are now live. So, hello and welcome to those of you joining just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Jillian and Michael here with me in the Zoom room. They are ready to begin their presentation on time. That it will be at 2:15 p.m. Eastern Time, coming up in just a few short minutes. Thank you all so much for your patience. I hope you're enjoying the show so far. To anyone just joining us, hello and welcome. This is your Money Show host speaking. We will be getting started in just a couple of minutes now at 2:15 p.m. Eastern Time. Thank you all so much for your patience, and I hope you're enjoying the show so far. Hello, everyone, and welcome to the session. It is my pleasure to introduce to you Gillian Wolfe and Michael Casper, equity strategists with Bloomberg Intelligence, with Gillian covering global and Canadian markets and Michael focusing on the US equity markets. They're here today to share some of our expertise with us, and they have a lot to get through in this presentation. So, to our live viewers, if you have questions for our speakers, please share them in the live chat box on the right hand side of the video player. If we have time at the end, we'll do our best to get to some of those questions. With that all said, Michael and Julian, I will hand the mic on over to you. I'll be here if you need me, but the floor is all yours.
Thank you. Good afternoon, everyone. I'm Michael Casper. I'm a senior U.S. equity strategist on the Bloomberg Intelligence team. I'm joined by Jill Wolfe, who is a global equity strategist on our team. First, a little bit of housekeeping on Bloomberg Intelligence broadly. This is the research arm of the Bloomberg terminal. We have over 500 data contributors covering over 135 industries and 2,000 plus companies. The average analyst has about 15 years of experience, and our coverage encompasses strategy, equity, credit, ESG, government, and litigation. So if you're interested, please do check out BI Go on the Bloomberg terminal. Getting into the US, the theme of today is going to be broadening. So a broadening rally to encompass more than just tech and communications. But first, our market pulse gauge. So this is a short-term or near-term sentiment indicator meant to assess when risk appetite is overheated or sentiment is completely washed out, what we call manics or panics. If you looked at this model back in July, this 6 cross equity and bond factor model would have said that the US equity market was getting a little bit overheated, that risk appetite was getting a little bit overheated. Typically, when that happens, that signals slower forward returns for the market at large, so the Russell 3000 we're talking about here, and large caps tend to outperform small caps, defensive sectors outperform cyclicals, and so on. If we do get a panic, which those signals are particularly meaningful, the last few that we got were in 23 and 24, that signals that sentiment is washed out, small caps outperform, and the opposite is true, so cyclicals outperform defensives. But right now, that has moderated to neutral, and a lot of that was driven by the sector rotation under the surface in August that we saw kind of away from tech and kind of trying to preempt what the Fed was going to do in the September meeting. Next slide. So overall, when we're talking about US equity market health, so this is a longer term view of US equity market health, we assess 17 factors qualitatively. So we look at the charts for all of the factors and assess whether that's favorable or unfavorable for the US market as a whole. And what we're seeing now is about 9 of 17 of the factors flagging green for the US equity market. If you took a look at this thing back in the fourth quarter of 2024 and even the first quarter of 25, what you would have seen is a sea of red. So you would have had a lot of these factors looking unfavorable for the US equity market, and that got even more exacerbated as we went into the Liberation Day announcement of all the tariffs that came down the pike against our trading partners, right? So that deteriorated the outlook for stocks meaningfully. With the second quarter, we saw some rebound, and now with the third quarter update, mostly green. There's 2 big reds here, economic regime model, which I'll get to in a second, and the market regime model, which has been in a red regime for quite some time. Next slide. But looking at the economic regime model, this assesses the probability that the US economy is in an expansion right now. So that 0.44 reading on the left-hand panel is a 44% chance that the US economy, based on the 4 factors that we look at to assess economic health, ISM, manufacturing PMI, continuing claims, capacity utilization, and consumer sentiment, those right now suggest we're in something like a very weak recovery phase. This thing has been flickering in and out of a recession signal below a 0.2 probability or a 20% probability of expansion is typical of recession. It's been flickering in and out of a recessionary signal for the better part of 3 years now. Typically, when you hit those recessionary signals, though, those are the strongest forward returns for both the S&P 500 and the Russell 2000. So if you think about what happens during a recession, stocks get completely washed out and then face usually a very swift and strong recovery. Think about your March 09 bottom, your March 2020 bottom. Stocks really recovered and had the strongest recovery off those phases. And the recoveries off those momentum lows, even in something that wasn't declared an NBER recession over the past 3 years, has driven significant recovery in stocks. Now we're in this weak recovery phase, and that's typically the lowest forward return basket for both the S&P 500 and the Russell 2000 on a 3 and 6 month basis. So the economic regime model is signaling that returns might slow, the recovery being kind of weak in the US. It's really no wonder why the Fed had to renew their rate cut cycle. The recovery just wasn't gaining enough steam. So the hope is, with rate cuts coming down the pike, that hopefully in the next 6-12 months, we start to see a more meaningful economic recovery and move towards the expansion phase. By the way, between a 92% and 100% chance of expansion based on this model is the second most favorable return regime. So the hope is that we move closer and closer towards a full-blown expansion in the US, given the Fed rate cut backdrop. Now, in terms of rate cut cycles, if you look across every single rate cut cycle and just delineate it by the first day that the Fed started to cut rates and end it when they stop cutting rates, right? It's very favorable for stocks. And even though many of these Fed cut cycles do occur during recessions, you still have a favorable return backdrop for both the S&P 500 and the Russell 2000. So across all rate cuts for the S&P 500, about an annualized average 15% gain. If you look at it on a small cap basis, 19% is the average annualized gain. So small caps do tend to edge out the S&P 500 during rate cut cycles. Those returns rise even faster, closer to 25% on an annualized basis for both the S&P 500 and Russell 2000 if the US economy avoids a recession when the Fed is cutting rates, which is currently closer to our base case and closer to, in fact, what stocks have been tracking since the Fed initiated their first rate cut in 2024. Next slide. So I'd be remiss if I didn't talk a little bit about the risks, though, to especially the S&P 500, and primarily the risk to everything and the ongoing rally for the S&P 500 is the multiple on the index. So on the left-hand panel, you have the equal weighted S&P on a trailing and forward basis. And if you look at it on either, it's pretty close to average. The equal weighted index is pretty close to its average multiple. On the right-hand panel, you've got the cap weighted index. And the cap weighted index on a forward 12-month basis its multiple is topping out around 23 times, which is where it topped out at the end of 2024. It's getting awfully close to topping out around the 24 times mark that it got to in 2021. So certainly the cap weighted multiple is risk. Now, even if you remove the Mag 7 from the S&P 500, multiples are still quite a bit above average. Not quite as high. You do lose about two and a half turns, but still significantly high. So multiples are a risk to the S&P 500, even though the Fed is cutting rates. But again, there could be this significant economic tailwind for S&P 500 stocks. And in terms of fundamentals have really driven the S&P 500's rally this year. So if you looked at what consensus was expecting at the beginning of the year, before all the Liberation Day tariff announcements, the S&P 500's earnings forecasts were cut dramatically in the first half. We're talking the second quarter, which had just reported, consensus expected about 10% growth at the start of the year. They cut that all the way down to 2.8% at the start of the season. But what ended up happening is the S&P 500's growth ended up being right around the original mark. So we ended up with about 10.4% growth in the second quarter for the S&P 500. So forecasts are slowly healing as the effects of tariffs prove to be less than what consensus thought they would be, right? So everybody expected that tariffs would take a big bite out of the consumer, a big bite out of S&P 500 earnings, and that just hadn't materialized in the first half. Now, second half forecasts, I will note, they were 14% going into the year. They're now down to 7%. The tendency is to beat, so we'll see if that mark does climb higher, but still, the effects of tariffs were significantly less. And consensus does see some acceleration in the EPS growth picture in 2026 and 2027, which could drive considerable sector recovery. On the right-hand panel, we have earnings breadth for the S&P 500. Typically lows and highs in that confirm lows and highs in S&P 500 price. And right now, we just made a new high in the post-2021 cycle at 70% of companies growing their earnings year over year. Next slide. So in terms of the Russell 2000, I wanted to dive a little bit into the small cap coverage that I have as well. What we saw, and this is our fair value model from about 3 months ago. We'll be updating this in the next couple of weeks. What we saw was considerable room for expansion on the small cap multiple 3 months ago when we looked at it. So based on consensus rate expectations, it suggested an estimated year ahead price to sales of 1.36 times on the Russell 2000. If you look back 3 months ago, that multiple was around 1.1, 1.15. So this model was pretty prescient in saying that the Russell had significant room to recover. Now, the additional room that we've had, of course, we're at all-time highs now in the Russell 2000, is driven by the Fed's new rate cut cycle. So when I update this again, I totally foresee multiples or the suggested multiple by our fair value model climbing even higher. On the right-hand side, it's quite interesting. The sales growth picture for the Russell is considerably weak, though. A lot of that driven by the weak macro backdrop that I had highlighted with the economic regime model. New orders growth of just 2% is particularly anemic across multiple economic cycles, and that's what consensus was suggesting just about 3 months ago, and that leads you to 1.3% sales growth, well below the average for about 4.5–5% sales growth over the course of a year. Next slide. And in terms of small caps, I had mentioned ISM as a meaningful indicator. In our economic regime model, it's an especially meaningful indicator for small cap stocks. And now ISM manufacturing, the 50 line, that white line in the chart, is the delineation between contraction in the signal and expansion in the signal. And the ISM manufacturing has spent the better part of 2 to 3 years in contraction. It's the longest period on record in contraction that hasn't been affiliated with a recession. And typically, small cap stocks really do take a lot of cues from the manufacturing economy. So when this ISM signal is an expansion, if you just delineate it by above 50, below 50, small caps typically gain 16% in the year ahead versus 14% for the S&P 500. So we're really watching ISM manufacturing to make a turn. If it does make a turn towards expansion, possibly helped along by the Fed and lower rates, you could see a significant small cap outperformance cycle. And just lastly, it's worth noting that small cap relative valuations are plumbing 17-year lows versus the S&P 500. So the Russell 2000, extremely cheap on a forward price to sales basis relative to large caps, could really goose returns here. Again, should the economy start to pick up with the Fed rate cuts, and if we do avoid recession, small caps could certainly be a big beneficiary of that. With that, I'll hand it over to Jill Wolfe for the global outlook. Thank you.
Thanks, Mike. Thanks for that great overview of the U.S. markets. I'm a global equity strategist here at Bloomberg Intelligence, and my job is to really put both U.S. performance and the rest of the globe in perspective. It's funny because Mike and I sit right next to each other, and Mike is a little bit more bullish on the S&P 500 and U.S. performance. I agree with him, but notice quite a few unique headwinds that are facing the U.S. relative to international stocks. So I want to put a little bit of perspective on the US versus the rest of the globe. It is important to note, and I think some people have a bit of a myopic view on this, that the US has actually underperformed international equities in local currency terms year to date. There's a few major headwinds that I want to get into that are facing the US uniquely and broader global trends that we're seeing. And the good news about maybe some of this US cooling off relative to international stocks is that it could reduce some of the equity concentration risk that's really started to emerge in the global equity market. Okay, just filling with my slides here. So like I said, the US is roughly middling relative to international stocks this year. It ranks about 9th in terms of year-to-date performance of the major 20 markets. It's important to know that year-to-date and quarter-to-date, the U.S. is trailing the Canadian market, the Japanese market, China, and the emerging market space as a whole. The only major market it's really been beating thus far is Europe, again, in local currency terms. So even though we've seen quite a bit of U.S. expansion and a quite strong U.S. equity market rally, it hasn't really been enough to compensate for the fact that the first quarter was so bad for the U.S. compared to the rest of the globe that they've basically been in catch-up mode for the rest of the year and really haven't quite caught up to some of these other markets just yet. And as the U.S. enters this new rate-cutting cycle, we wanted to point out that unlike the first cutting cycle that started in September of 2024, the U.S. is entering on a bit of a weaker economic footing relative to the rest of the developed market economies. So this is our developed market macro scorecard. The numbers here are the percentile ranks of these major indicators relative to each market's own history. We use this to gauge how strong an individual economy is relative to its own history. And you can see that around mid-2024, when we went into those first rate cuts, the U.S. had a roughly middling average economy, while some economies like Germany, Switzerland, Canada, and Australia were looking quite weak. after this rate cut cycle, we've seen some more strength emerge in those economies, and now everything is roughly middling. So the US having a roughly average economy isn't as special right now as it was maybe heading into 2024 when there was more, or heading into 2025 when there was more weakness abroad. And one real major headwind we see for the US, even as these US rate cuts start to pick up, is the benefit from those rate cuts may be muted slightly because of the fact that US valuations are so stretched relative to their own histories. We actually saw this in the wake of the September 2024 rate cuts, that the US has done on median, well, about on par, a little bit worse than the countries that entered that cut cycle cheaper relative to their own history. So countries that were expensive like the United States, Taiwan, Australia, India have not benefited as much since the start of this global rate cut cycle as countries that entered that cycle relatively cheap relative to their own history, like China, Canada, Korea, and Brazil. Right now, we've seen a bit of this shift. We've seen Canada start to become quite expensive now. China's also become much more expensive relative to its own history. So as we enter into this new cut cycle, they may also not benefit as much, but you still have some emerging markets that are pretty cheap relative to their own histories, like Brazil, Mexico, even Korea is still a bit cheap, even though they've rallied quite a bit. The UK and South Africa don't screen as quite as stretched. So they're more likely to benefit from this rate cut cycle since at first, usually the mechanism by which stocks rally after a rate cut is through valuation expansion, not as much through earnings. You typically see that later on in the cycle, but with valuations so stretched, these expensive markets like the US may see more of a limited boost. One unique headwind that's also facing the US right now, even though we've seen some headlines saying that inflation hasn't really picked up too much, maybe the tariff threats aren't going to be as bad as people think, what we've noticed is that relative to the rest of the globe, US inflation is heating up. So we've seen an uptick in US CPIs over the past few months where we've actually seen CPIs cool off broadly in the rest of the world. You're definitely seeing relative to each other this more difficult environment for the US as we head into this cutting cycle of trying to rein in inflation while the Fed is also cutting. The rest of the globe isn't contending with this as much. They could continue to cut more freely because inflation hasn't really been trending upward. Now, tariffs might ultimately flow through to global inflation outside of the US more intermediate term, but definitely nearer term, we're expecting to see more of that inflation impact hit the US, which could complicate things for the Fed as we move forward into this cutting cycle. Another catalyst I want to point out for global stocks that really isn't going to be as much of a boost for the US is the gold rally. Gold just keeps going up, and US materials, that sector is really not as sensitive to gold going up or down as some markets like abroad, like South Africa or Canada, which have a very heavy metal and mining sector. So we've actually seen a huge boost to the broader Canadian and South African equity markets as a result of this gold rally. And this is not really a catalyst the US participates with. The US materials sector is much more chemicals focused, as are developed market materials sectors in general. We actually see gold as really a major catalyst for emerging markets materials and maybe emerging markets in general, less so for the developed market space, which tend to be tilted much less towards metals and mining and much more towards chemical development, with Canada a bit of an outlier and an obvious exception in that developed market space. On to earnings estimates, we like to take a look at our bellwethers every quarter. These are the largest, roughly 150 or so stocks across the globe, both in the US and beyond, that represent at least half of the market cap of all of the major sectors in every major region. And we saw going into 2024, or what we saw actually over the course of 2024, was that US earnings growth had really accelerated past earnings growth in developed ex-US markets and emerging markets. We got a lot of that boost in the US here because of those AI firms. Now what we're seeing is that in 2025, we still see a bit of this US outpacing the rest of the globe, like emerging markets or developed markets ex the US. But as we head into 2026, even though on an absolute basis, we're looking to see US earnings growth accelerate, relative to the rest of the globe, earnings might be closing in a little bit more. This AI trend is contending with some really difficult comparables right now. So we're looking to see more growth maybe in the XAI space, which could boost the fundamentals outside of the US and bring them more in line with US earnings growth. That said, the US earnings growth outlook for 2026 is still more positive than it is in the rest of the globe. But what we found is that when it comes to relative performance, we also want to take a look at relative earnings growth, right? It's not about who is growing the fastest, it's about who's growing the fastest relative to one another. And in 2024 and even the forecast for 2025, the US is much more of the obvious winner. Going into 2026, we're definitely seeing some convergence with the rest of the globe. What does that mean for really global equity investing as a whole if the US slows down? Over the last 12 months, we've seen that the majority of the earnings growth, just in terms of US dollar terms across all of equities across the globe, has come from the United States. So we've seen about $400 billion of earnings growth occur year over year over the last 12 months across equities all across the globe. About 270 billion of that growth came from the US alone, with about 60 billion coming from China. What's really interesting here is if you were to actually eliminate the US and China from the global equity picture, the rest of the markets did not exhibit enough growth to offset the drag from Europe ex the UK over the last 12 months. We would have actually seen a broad earnings contraction occurring across the globe if it weren't for the US and China offsetting some of that weakness. So that definitely poses a bit of a risk to the global equity market outlook. But as we go over the next 12 months, we're definitely seeing the US share of the pie expected to decrease. So again, a roughly $400 billion of growth year over year, USD expected, only about $200 billion expected to come from the US, a little bit less this time, with more growth and participation broadly across the rest of the globe. So reducing some of these risks maybe over the next 12 months of the US and at least China as well, really carrying this global equity outlook and some global equity health. We see this rally in China also as a bit beneficial for this global equity concentration problem that we've run into. What we've noticed is that over the last few years, really 2023, 2024, and year to date, the net market cap added from the 10 largest growers has made up over 40% of the total market cap added from the entire global equity base. So you're getting, if we've seen year to date, about $16 trillion of equity cap added to the globe. The 10 largest growers alone have added about $8 trillion to that, with the rest of the roughly 2,500 or so equities across the globe contributing to about 8 trillion as well. So we really see a lot of the growth and appreciation in the market coming from just a few of these mega cap stocks. A lot of those are concentrated within the US, so we have seen some participation from some of these tech 8 names in China. And we're hoping that as we see maybe tech accelerating in China a little bit more in the Chinese market, which really is home to a lot of these mega behemoths across the globe, we could see a little bit of this concentration disperse a bit across the globe in terms of what is actually driving market cap appreciation. Hopefully normalize us a little bit more to the pre-2020 era where the largest 10 growers contributed to between 10 and 20% of overall market cap growth, now between 40 and 50%, which is what we're seeing right now. One thing to note is that even though a lot of indexes are reaching new highs, there isn't exactly a perfect correlation, at least in the last month, with the percentage of stocks reaching new highs in these markets and the percentage by which that market has reached new highs. So we're definitely seeing concentration in a lot of markets themselves. So for instance, in the US, we saw new highs about over 1% of the peak, even though less than 20% of the individual stocks in that market managed to hit new highs. We saw a little bit less concentration in markets like Japan and Canada, which also hit new highs, but had a bit more participation. In Australia, the UK, and Taiwan, those new highs were not associated as much with broader participation from the market. So again, we still have this equity concentration risk looming across not just the US and global as a whole, but definitely within some of these individual markets where the index itself might be rallying, but the underlying stocks may not be rallying as much or as broadly. This really is a testament to how much stock picking matters right now. If you happen to pick the wrong stocks in an index, you may not be tracking that index's performance as well as you think, and stock picking is becoming ever more important across the globe. That wraps up the global portion of this. Just these final housekeeping items that I'd like to touch on. We have a Bloomberg Intelligence and Bloomberg Economics macro call every Monday morning that you could sign up for, whether you're a Bloomberg client or not, using this Zoom ID. Michael Kalpster and myself contribute to this call, as well as some of our great economists, rate strategists across the globe. We do host a quarterly Zoom breakfast with BI stocks. We will send out more information about the next one shortly. And if you're interested in accessing our distribution list, if you are a Bloomberg subscriber, we definitely can add you to that. This will give you access to all of our research over the last week. We send this weekly, links to the terminal where you can find our research reports. You can also follow myself and Mike on LinkedIn when we post a lot of our latest charts and a lot of our latest research. We also have a newsletter that goes out where we point out some of the most interesting stats from the week and the most interesting charts. If you're a bit more of a visual learner and don't want a list of what research has come out, there's a little bit more visual appeal to that newsletter, and you could sign up for either or both. I'd like to say a final thank you to all of you for joining. We do have a global equity team scattered throughout the globe. Myself and Mike's in New York. We have European market specialists in Europe and Asia and China specialists over across the globe in Hong Kong and Singapore, covering really most of the major stocks in the MSCI ACWI. So please do not hesitate to reach out, again, Bloomberg client or not, to some of our strategists if you'd like some additional information. With that, I think we have a few minutes left. We're happy to do a little bit of Q&A. If anybody would like to add to the chat box. Mike, I don't know if you have anything else to add, if you'd like to add anything in the last few minutes.
Mm-hmm.
Okay, great.
All right. Well, I do have a question for you guys here. Eugene had asked this a little earlier in your presentation, actually right when you got started. So it's possible you've covered this a bit, but he's asking about crude oil. In your opinion, do you think crude oil prices will continue its stability?
Sure. Mike, do you want to take this or should I?
Yeah, I'll take it. So we don't necessarily forecast crude oil prices. I would refer you to Mike McGlone, who's our senior commodity strategist in BI, necessarily, but we do look at crude oil from a few different lenses, right? So in our large cap fair value models, it's a huge component. Commodity growth is a driver of S&P 500 earnings. But I will note that to a certain degree, when oil prices get too high, it's a huge margin issue for U.S. companies. So I'm talking, when we challenge highs from the previous cycle north of $100 a barrel and stuff like that, it could get really challenging, especially for industrials companies and heavy manufacturers in the U.S. And we really watch margins and the effects of oil on margins there. But in terms of forecasting oil prices themselves, again, I would refer to Mike McGlone on that.
I'll just add a quick note. More broadly, globally, we kind of break up markets into those that'll be hit on the bottom line and those that can ultimately benefit on the top line from oil production. So a market like Canada, for instance, which I do cover a little bit more in detail, that has a much larger energy sector, can offset some of the hit that some companies will take as a result of using oil as an input by the fact that there's so many large sellers of oil within that stock market. One thing I would caution investors about is that a market is not an economy and an economy is not a market, right? So in the US, we're a very large oil producer, but energy makes up a very small percentage of the S&P 500. So even when those oil producers are able to make more money, it doesn't move the needle as much. In a market like Canada, there's also a large oil producer, but for which energy makes up a much larger percentage of their public stock index. Those are really the markets that we see a potential boost in oil potentially helping more.
Thank you both. I know we've got just a minute left here, but I did get one more question from Eddie in the chat asking, do you think European defense stocks will continue to do well this year and next year?
Yeah, that's a great question and definitely something we've taken a look at. We do have a European equity specialist, Laurent Dulette, in Paris. He would definitely have more details on this, but one thing I would like to note about that is that, especially with the Europe trade in general, is Europe entered the year quite cheap. We've definitely seen multiples expand a bit more. So whether or not those multiples can continue to expand at the current pace is unlikely. It's not to say that there would be a reversal, but you had these stocks that were kind of beat up coming into the year that really fueled a lot of this rally. Value stocks have done very well in Europe, and now some of those defensives aren't quite as value-y right now. So it's something where this is a hot trade this year, but as some of that defense spending gets priced in, the pop that we saw in those stocks, I would say, is unlikely to continue to be as strong into the next year just because so much of it has been priced in already and because those multiples have expanded already quite a bit this year. We also have a thematic strategist I'd like to point out. So we run thematic baskets here. We do run a global defense basket, so stocks that track the defense trade and that would benefit from increased defense spending. You can find that as well on the Bloomberg terminal or by reaching out to our thematic specialist, Brian Doherty.
All right. Well, Jillian, Michael, thank you both so much for joining us today. Fantastic presentation. Glad we had a little bit of time to get to some audience questions in the end there as well. That was great. And of course, thank you to those in our live audience for joining us as well. And be sure to stay tuned as we have a lot more in store for you in this Money Show Virtual Expo. I hope you have a wonderful rest of your day. Take care.